When it comes to investing, a lot of people look at the volatility of a particular investment and then they think that that is indicative of its underlying risk. And it's an assumption that I made for a very long time as well. And I want to talk a little bit more about this concept, the difference between risk and volatility, and really what risk actually is. But before I do that, just want to introduce myself for anyone who's new to the channel. My name is Jack Duffley, and I'm a real estate attorney and investor. If you end up enjoying this video, I'd very much appreciate it if you hit that like button and also subscribe below. I put out new videos every single week. Now, before we get into an example, let's figure out what volatility actually means. I've got the dictionary definition right here. Volatility means the liability to change rapidly and unpredictably, especially for the worst. When we apply this concept to finance and investing, it generally refers to the price change and the price movements in a particular stock or investment in a particular period of time. So the more volatile an investment, the more it will go up and down in price within a given period. Now here's why volatility in particular is not risk. Let's take an example of a volatile investment. So here is the value of the investment. We'll say that it starts around here and it zigzags violently up and down and it's going all over the place. And we'll say this is over a couple of years. So maybe at the end of a couple of years, you actually ended up on your investment. But wow, look at all that volatility. It went down at some certain points, went way up at other points, but you ended up. And here's, I'll do like a dotted trend line here, show you where that investment ended up. But very volatile along the way. It was bouncing up and down a lot. We'll say this is a year or two in time frame. Now let's compare it to this investment. That same period of time starts at the same value, but it just slowly and steadily drops all the way down to almost zero. Same amount of time, but wow, it wasn't volatile at all. It was actually just a straight line down. Here, we'll even do little squiggle lines. So this was what the price action looked like the whole time. So really staying close to that trend line, didn't really do much by way of volatility. Now, if you knew that either of these cases were going to happen, which one is more risky? Does it really matter that the price changes in this example were much bigger in a shorter period of time, but you ended up on this one, you ended down on this one, so is volatility really the problem here? This investment on the bottom was way less volatile compared to this one up top, yet it lost way more money in the end. So volatility isn't really what determined how great this investment was, because in the end, this one lost a bunch of money, this one actually made money, even though this one was way more volatile. And the opposite can be true as well, so I'll go ahead and erase this bottom one, and let's say that this one is actually even more volatile than this top example, starts around the same point, and it goes way up, almost all the way back down to zero, way up again, even higher, almost breaking this chart, goes all the way back down to zero, way up, and it ends around the same point where it was before. We'll go ahead and do the trend line here. Is this any less risky? So in this case, it looks like the volatility is what's causing the risk. Look how much more volatile it was than this one, and it ended up in a way worse position. But again, I'll go ahead and draw kind of the graph we had before. This one ended up at the same endpoint. So which one was really more risky? The point is, volatility is not risk. Risk is the chance that you lose your capital, the permanent loss of capital. What is the chance of that happening? That's what determines your risk. And in this case, assuming you actually knew that this was going to happen, then the chance of you losing money here is greater than this top example, where even though it's quite volatile, you still ended up. So the volatility isn't really the key factor here. It's actually the risk of losing money, or I guess in this case, making money as well. That's really what matters. Some things you invest in might be extremely volatile for whatever reason, but your risk of losing capital isn't actually that high. So that investment really isn't necessarily risky. Now, volatility can become risk in a couple of cases. So let's go over those now. The first case where volatility can actually become risk is when you have debt, and more specifically, something like margin debt, callable debt, or something where you actually have to make your payments even though you have your money tied up in your investment. So with stocks, what often happens is if you take out margin loans, that means that if your stock values fall to a particular point, that could allow the brokerage to force sell your stocks to pay for the debt. So in that way, if you have some severe negative volatility, that could actually force you to sell. You don't have time to hang on to it because you have to pay back this debt. So in that way, debt can cause volatility to become risky in that way. And it's not just margin loans, that's just a particular type of callable loan, but even with something like a long-term fixed rate mortgage on a piece of real estate, if you can't make the payments, that could trigger foreclosure. So if you have volatility in the rental market where you can't keep up rents to pay for the expenses and to pay for the mortgage, you're gonna be in some trouble. So in that way, volatility becomes risky. But that does kind of beg the question, is it really the volatility that's the risk, or is it the debt that is the risk? But anyways, another example on a very similar note is money you can't lose, investing money you can't lose. So money you can't lose. That's where you're investing money that you need in some shorter period of time, and you don't really have control over when you can actually sell this. Maybe you're investing your entire emergency fund, and then you have an emergency pop up, you don't have the cash, you now have to liquidate your investments. So if you're in a very volatile investment and that thing has fallen recently, you're gonna be forced to sell at those lower prices. So in that way, once again, volatility can add to the risk. Third example is if you have a very short time horizon. So I'll just go ahead and say if you're a trader and you're trying to day trade stocks, you're trading stocks on a very short time horizon, really any investment, to where volatility is going to make a big difference because you're trying to get out of a position in a very quick amount of time. So in that case, you're actually using the volatility as the investment. So in that way, volatility, I guess, can become risk. And depending on what you're trading, the volatility can help and hurt you because you have such a short time horizon. So the more volatility, the more price action you're going to see in a shorter period of time. And when you're trading, that, I guess, is what you're really looking for. But in that case, is the volatility really the risk, or is it really your time horizon that's causing that to be the case? Because you're not letting things play out over the long term because you're trying to get in and out of positions. But the general theme with all three of these things is that you're not allowed to wait. You have to liquidate your investments. So if it's volatile and it's spiking downwards, I'm not sure if spiking downwards is an oxymoron, but in general, if your investment is falling quickly and it might not actually be going to zero and you're pretty confident in its prospects long term, you don't think the risk of permanent loss of capital is really that high if you're allowed to hold that investment. But that's the key. You have to be allowed to hold it and work through that volatility. Because when you don't have the option to wait out the volatility, at least when it's going towards the downside, then that's where you run into trouble, especially with these three sort of factors. But the point here is that volatility is different from risk, and you can have an investment that's extremely volatile, but really isn't all that risky unless you introduce some of these outside factors that suddenly shorten your time horizon and put you in a much riskier position to actually lose money permanently. But just because something is volatile in itself does not mean it is necessarily more risky than some other less volatile investment. And as Warren Buffett likes to say, the first rule of an investment is don't lose money, and the second rule is to never forget rule 1. Anyways, if you guys like this video, definitely like it since that would help the channel out a lot, and be sure to subscribe since I put out new videos every single week. Till next time, take care.